Good evening, students. Welcome to the session. So, there's one just short announcement to be made. So, if you see in the schedule, you see there is a lecture on Sunday, 28th, right? But that lecture has been postponed to Tuesday, which is 30th of September. So, for direct taxes, you do not have the lecture on Sunday, 28th. Instead, it is there on 30th September, right? So, just make a note of that. And let us quickly begin with the session. So let us quickly revise what we have done in the last class. Can somebody do a 2-3 minute recap for me?
Yes, ma'am.
Yes.
First, we have seen clubbing of provisions, section 60, transfer of income without transfer of asset. It is to
Mm-hmm.
be included in the hands of the transferor. Then
Mm-hmm.
section 61, income arising from the revocable transfer of the asset. It has to be included in the hands of the transferor. Revocable assets are which the transferor has the right to regain the power at any time during the lifetime of the asset. During the lifetime, then we have for that there is an exception, section 62. If it is by way of transfer of asset through the trust, uh, not during the lifetime of the beneficiary, then section 61 will not attract. Clubbing of provisions will not be attracted, or by any through any other means. Then also during the lifetime of the beneficiary who is getting that asset, then section clubbing of provision will not be attracted. Then section 64, remuneration to the spouse. Remunerations to the spouse from a concern in which the individual is having the substantial interest. Substantial interest is a person having greater than or equal to 20% of the voting power if it is a company, or having more than greater than or equal to 20% profit sharing ratio. Then the income will be added in the hands of the person who is giving the remuneration to his spouse. If both the person is having the substantial interest, then it will be added in the hands of the higher remuneration who is drawing the who is having the highest total income. Then this
Yes.
provision will not be attracted. Exception to this, if the spouse is having a technical or professional qualification.
Hmm.
Then what house property deemed owner. If the house property is transferred to the spouse without adequate consideration, then section 27 will be attracted, deemed ownership, and income gross annual value will be chargeable in the hands of the transferor as a deemed owner in under income from head for house property. If other than house property, then it will be charged in the hand charged through clubbing of provisions. Then with what we say, accretion of the amount is not chargeable. The clubbing of provisions will not be attracted on the accretion of transferred asset. Then, if the asset is invested in the business, then the proportionate amount of income will be added in hands of the transferor. We have to look into the investment on the first day of the previous year to the total investment of the year. Then, if it is for a bona fide loan is given, then clubbing of provisions will not be attracted. And your capital gains and 56(2)(10) gift will not be attracted as it is not a transfer under section 47, and it is a gift from a relative, so 56(2)(10) will not be attracted. If the transfer of asset is given to any person or a association of person, then without any adequate consideration for the benefit of the spouse, then that income will be added to the in the hands of the transferor. The same provisions will be attracted for the son's wife.
Well,
Then clubbing of minor income, minor income will be added in the hands of the parent, which is having the highest total gross total income. Other the exception to these are the skills. If the minor is doing some labor work as skill, then it will not be attracted. And if you have disabled, on which deduction under section 82 is available, then this will not be allowed. This section will not trigger. And as a, assumption under section 1032, 1,500 per children will be given under out of the default regime 115 BSC. If it is a default regime, then this assumption will not be allowed. And for the house property, if the house property is transferred to the son or a unmarried minor daughter, then deemed ownership will be triggered and it will be taxable in the hands of the transferor. And if it is to the if it is any other asset or to the married minor daughter, then clubbing of provisions will be attracted. Then cross transfers, if the two transactions are circuitous may be done so as to represent a single transaction and to avoid the tax, then the amount that is cross transferred will be taxable, clubbing of provisions. And if the property is transferred to the HUF, then the income arrived from that such property will be included in the hands of the transferor. And when the HUF divides the partitions this property, then whatever the property that gets to in the hands of the spouse, that will also be added to the in the hands of the transferor. Then we have seen losses. Uh, set off of losses. First, we have to set off intra-head, intra-source of in same head in interhead. Exceptions to the long-term capital loss can be only adjusted to the long-term capital gain. Speculative business can be adjusted. Speculative and specified business losses can be adjusted against the specified incomes only, and horse winning also can be adjusted against same thing. And exempt loss cannot be set off against a taxable income. Income from house property losses can be set off against any other head up to the 2 lakhs in out of the old regime if 115 BSC. If it is in a new regime, default regime 115 BSC, then no house property, self-occupied house property will not be set off, will not be allowed, and moreover, brought forward is also not allowed. If it is a let out, then current year loss can be set off against the current year revenue of only income from house property only, and it will not be carry forwarded also. And if it is in a old regime, then the set of self-owned property, it can be up to maximum of 2 lakhs and it can be carry forwarded up to maximum 8 years. Then business loss can be cannot be set off against salary, and it can be set off against any other source of any other head of income maximum, and it can be carry forwarded maximum up to 8 years. And specified business can be only adjusted against the specified businesses, and it can be carried forward indefinitely. Speculative business can be adjusted against only speculative business, and it can be carried forward at up to maximum 4 years. Short-term capital gain can be adjusted against short-term capital gain and long-term capital gain and carry forward up to 8 years. Long-term capital loss can be adjusted against only long-term capital gain, carry forward up to 8 years. Winning of
Yes.
horses can be adjusted against only winning of the horses, and maximum up to 4 years. It can be carried forward.
Very good. So this is what we have covered till now. Very well summarized. Thank you so much. So now we move towards the next balance section on the set off and carry forward. See, we are going to finish it very soon, right? So after this, we will start with the chapter 6A deductions. The next topic once we are done with this set off and carry forward, and then we'll start with the chapter 6A deductions in the second part of our class. Okay, now we are going to deal with first section 72A. If you recollect, I told you one principle, students, that you can set off the losses, and the one person who carry forward the losses has to be the same, right? So the person who is carrying forward the losses and the person who is setting it off has to be the same person. And we had noted one exception for that. What was the exception? Can anybody recollect?
Succession of the business.
Inheritance.
Yes, succession of business through the inheritance.
Inheritance.
Isn't it? Yes. So we noted that it was clearly written under 72 that the person who incurred the loss alone is entitled to carry forward and set off the loss. And the exception was the succession by way of the inheritance. Right? Now there are other exceptions also, which is one is 72A. The set off and carry forward of losses in the case of amalgamation or demerger. We have studied about amalgamation and demerger, right? You would have done about the amalgamation and demerger under capital gain. Yes?
Yes, done.
Correct? So, if you look at it, the capital gain on the amalgamation and the demerger doesn't arise. Right? It is not regarded as transfer.
Yes.
Correct? Now, with respect to the losses also, the losses of the amalgamating company or of the demerged company become the losses of the amalgamated company or the demerged or the resulting company. Now here there are certain conditions which are there that you have to follow, basis which you will get the losses. So even if the losses were of the amalgamating company or demerged company, the amalgamated company or the resulting company can carry it forward only when these conditions of 72A are satisfied. What are the conditions? First of all, it is applicable to these entities only. Only these four entities. What are the entities which are covered under 72A? A company owning an industrial undertaking or a ship or a hotel who gets merged or amalgamated with another company. Are we getting it? So, company owning the industrial undertaking or the ship gets merged with the another undertaking. Now, what is the meaning of the industrial undertaking over here? The industrial undertaking here means, we will see what is the meaning of the industrial undertaking. Let me show you the meaning of that. Yeah. It means any undertaking which is engaged in manufacturing, processing of goods, manufacture of the computer software, business of generation or distribution of electricity or power, telecom services, mining, and the construction of the ships, aircraft, or the railway systems. These are the companies which are covered under 72A. Right? So, under 72A, there has to be an industrial undertaking. Alright? Which has to merge with the another company. Then another company can be any company. They are not saying that it has to be also an industrial undertaking. Or a company owning a ship or a hotel. Clear? Second is a banking company with a specified bank. Third is a public sector company with another public sector company. Or the fourth one is an erstwhile public sector company. The company was earlier a public sector company, which has now ceased to be a public sector company because of the disinvestment by the government. Can anybody tell me an example of a company which used to be a public sector company but no more is there?
Air India?
Airline industries.
Correct? Air India. So, these are the companies which are sought to be covered. If the share purchase agreement is entered into under the strategic disinvestment, restricted immediate amalgamation of the said public sector company, and the amalgamation is carried out within the 5 years from the end of the year in which the restriction on amalgamation in the share purchase agreement ends. So basically, an erstwhile public sector company merges with another company. Okay, under which the government strategically disinvest. That is, strategic disinvestment means the government reduces its shareholding from the majority shareholder of 51% and transfers the control to the buyer. Are we clear? So these are the cases which are covered under the 72A. What are the companies which are covered? A company owning the industrial undertaking, company owning the ship, company owning the hotel with any company. Banking company with a specified bank. public sector company with another public sector company. Erstwhile public sector company with the any other company. Are we clear? What is an industrial undertaking? Manufacturing, processing of goods, software, mining, right? Generation, distribution of power. These are basically the examples of the industrial undertaking. Now, only when you satisfy this applicability test, then the accumulated loss and the unabsorbed depreciation of the amalgamating company shall be deemed to be the loss or unabsorbed depreciation of the amalgamated company. So it is saying it shall be deemed to, Maruti was not a public sector company, Geet. So it shall be deemed to be the loss of the amalgamated company. So not only the business losses, even the unabsorbed depreciation. Even the unabsorbed depreciation is going to get covered under the 72A. So the amalgamated company not just carry forward the or can carry forward the losses, business losses, but also the unabsorbed depreciation as well. Are we getting this particular point? So one has to ensure that these conditions or they fit into the applicability. Are we clear? Any questions so far? Is it clear, students? Yes or no? Yes?
Clear, ma'am.
Clear.
Okay. Now, in the case of the amalgamation of the erstwhile public sector company with the another company, the accumulated loss and the UAD of the amalgamating company, which is deemed to be the loss or as the case may be allowance for unabsorbed depreciation of the amalgamated company, shall not be more than the accumulated loss or the UAD as on the date of public sector company ceases to be the public sector company as a result of strategic disinvestment. So what is allowed over here is up till the date when the government disinvests in that company. It cannot be more than that. So once it has been privatized, after that, if you will say that, no, I want to carry forward those losses also, no, that is not permissible. The maximum losses that can be carried forward by the amalgamated company is up till the date when it ceases to be a public sector company. Now, what are the conditions for the availing the benefit under this section? There are conditions for the amalgamating company as well as the amalgamated company. For amalgamating company, the conditions are that the amalgamating company should have been in the business for 3 years or more. It should have at least stayed in business because they want to avoid the cases where the new company start and close and then shift the losses to another company. Right? It is quite possible they will open the company, claim the pre-incorporation expenses, startup expenses, merge with another company and then, claim the loss against the profit of that new company. So what they are saying, it should have been at least in business for 3 years because after 3 years, you usually start generating profit. But if you don't start generating profit within for 3 years, then of course you can, merge with another entity. The amalgamating company has held continuously as on the date of amalgamation at least 3/4 of the book value of the fixed assets held by it 2 years prior to the date of amalgamation. Right? So the amalgamating company has held at least 3/4 of the book value of fixed assets held by it as on the date of amalgamation, what it was holding 2 years prior to the date of amalgamation. So it should continue to hold the 3/4 of the book value of fixed assets. It should not be the case that they have sold all the assets. They should amalgamate with the assets itself. Right? Sorry, students, I think there was some network glitch. Yeah. These are the conditions to be fulfilled by the amalgamating company. Now, there are also conditions to be fulfilled by the amalgamated company. The amalgamated company should hold at least 3/4 of the book value of fixed assets, which they have acquired as a result of amalgamation for a minimum period of 5 years from the amalgamation. Again, what they show is that the company which takes over the another company, they basically need to hold the assets. They should not, just be acquiring the company for taking over their losses. If they continue to hold the assets, 3/4 of the assets for a period of 5 years, it shows that they want to acquire the business and not just acquire the losses. So these conditions are put in place to prevent the buying out of the loss-making companies. Are we understanding this? The amalgamated company continues the business for at least 5 years. It should continue the business of the amalgamating company. And it should be for the genuine business purpose. Then the amalgamated company shall achieve the level of production of at least 50% of the installed capacity. Right? At least installed capacity of production which they have. They have the capacity of production. Let's say if the machinery is installed which has a production capacity of 10,000 units. 10,000, let's say, shoes. At least I should achieve the production of 5,000 before the end of 4 years from the date of amalgamation. Because then it shows that, okay, I'm trying to revive the earlier company's business. I'm not just taking it over and, okay, sitting quiet on it to claim the losses. And I should continue to maintain that same level of production till the end of 5 years from the date of amalgamation. And the amalgamated company should furnish the certificate of the CA to the AO that they have fulfilled these conditions. Now, what happens if they do not fulfill these conditions? The carry forward of loss and the UAD shall not only be now stopped, but it shall be treated as the income of the year of the amalgamated company in which there is a failure to fulfill the conditions. Are we clear up till now, students? Yes, any questions?
Clear, ma'am.
Clear?
Ma'am,
Yes.
ma'am, after how many years it can be carried forward and set up?
I was going to come on this. Now, I'm opening up here the section number 72A. I don't know why this site goes into the error.
Which means the leftover period in case of business loss, the 8 years is allowed. I think the remaining period can be allowed, I believe.
Yes. Let us read what the law says because there has been the amendment in the law. Sorry. I think I'm not able to open up this. Okay, let us leave it. Let us look at from the module because the site is also not working. So it can be carried forward for a remaining period of 8 years. Earlier, it used to be the case that you could carry forward and set off the losses. The amalgamated company can carry forward and set off the losses of amalgamating company for a fresh period of 8 years. However, now this has been amended and now it provides that it can only carry forward and set off for the remaining period of the 8 years. So earlier it used to, like, even if 5 years the company A has claimed the losses, now once it gets amalgamated, company B can claim for fresh period of 8 years. that condition is no more there. Now it says it can carry forward and set off only for the remaining period out of the 8 years. Clear? Yes or no? Any doubt? Any question?
Okay, ma'am.
Yes.
Fair. Ma'am, from when it is applicable, ma'am, that remaining period?
This year onwards. So this is the amendment which has been made from this particular financial year.
2025.
Yes.
Okay.
Fine. Okay. Now, with respect to the demerger, what it says, where there has been a demerger of an undertaking, the accumulated loss and the UAD directly relatable to an undertaking transferred by the demerged company to the resulting company shall be allowed to be carried forward and set off in the hands of the resulting company. And if the UAD or accumulated loss is not directly relatable to the undertaking, means it's a general loss, not related that to the undertaking, the same shall be apportioned between the demerged company and the resulting company in the proportion in which the value of the assets have been kept with the demerged company and transferred to the resulting company. Here, unlike amalgamation, there are no conditions. The only condition is it has to be, the demerger has to be for the genuine business purpose. For amalgamation, there were many conditions. However, for demerger, there are no conditions. And here also, you can carry forward and set off the losses for only the remaining period of the 8 years. I think I've been able to open this. Let us look at it. See, what this is, notwithstanding anything contained in any other provision of the Act, the accumulated loss and the UAD shall be deemed to be the loss of the amalgamated company. And in this particular case, what they are trying to say is that here, this particular loss which is there is now deemed to be the loss of the amalgamated company. However, if you look at, when any amalgamation or business reorganization is effected on or after 1/4/2025, any loss or UAD being of the amalgamating company, firm or proprietary concern, private company or unlisted company shall be deemed to be the loss of the successor entity, being the amalgamated successor company, successor LLP, shall be carried forward in the hands of the successor entity for not more than 8 assessment years, immediately succeeding the assessment year for which the loss was first computed. Clear? Yes or no? And what do we mean here by the loss? The loss under the head PGBP not being the speculation loss. It does not include the speculation loss. Clear? Okay.
Means, ma'am,
Next
before
is,
amendment,
yes.
before amendment, there is a fresh 8 assessment year, and after amendment, the remaining years.
Correct.
The remaining.
Correct. Keshav, you have a question. If amalgamation took place in the middle of the year, do losses of the amalgamating company up to that part of year, mid of the previous year, will be allowed to the amalgamated company? Good question. So, Keshav, there is something called as a concept of appointed date. What is an appointed date concept? Appointed date concept generally means that in the scheme of amalgamation, demerger, reorganization, you have to take the approval of the NCLT. Earlier, it used to be the High Court approval. Right? Now, prior to that appointed date is basically given for the purposes of that, okay, up till this date, whatever business receipts, whatever income, expenditure will be there, will be of the amalgamated company. Beyond that, it will be of the amalgamated company. Okay. So up till that, whatever losses will be there will be of the amalgamating company. And for the income tax, we follow the concept of previous year and assessment year. So in case the amalgamation takes effect during the mid of the year, you will consider the entire previous year only, right? Up till that point only. So up till that point, the business is discontinued. After that, the company is no more in existence anyway. So up till the date of the amalgamation, whatever losses will be there, that will now be deemed to be the loss of the amalgamated company. Clear, Kesha?
Yes, ma'am.
Okay. Next is the reorganization of business. Now, in the case of reorganization of business, whereby a firm is converted to a company, or a sole proprietary concern is converted to a company. You have seen this particular provision in the capital gain? Yes. Yes, it's not a transfer, right? In the capital gain, you have seen this 4713, 4714. So here what they say is that the losses and the UAD of the firm or the proprietary concern shall be deemed to be the loss or the UAD of the company. And again here, it shall be set off for the remaining period of the 8 years. In case these companies which have taken over the LLP, partnership firm or the sole proprietary concern have not complied with the condition under 4713 or 4714, then this loss and the UAD shall be deemed to be the income of the company in the year of violation of condition. What are the conditions under 4713 and 14? Can anybody tell me? Yes. What are the conditions? 50% ownership, okay. All assets liability. Yes.
All partners should be also be the shareholders of new company.
Correct. So all these conditions have been laid out under 4713 and 4714, and if you don't fulfill those conditions, then your capital gain which is exempted also becomes chargeable, isn't it? So here they say that if you don't fulfill those conditions, even the losses which are there will be added as the income of the successor company. Clear? Next is conversion of company into the LLP. It says in case of the conversion of the private company or the unlisted company into the LLP as per 4713B, right? Again, you have seen this provision in capital gain. Then the LLP would be allowed to carry forward and set off the losses of the predecessor entity, right? And in case you fail to fulfill those conditions, the losses will be deemed to be the income of the LLP. Now, what are the conditions under 4713B? Yes. What are the conditions, students? Turnover less than 5 crore, accumulated profit not distributed. Turnover is less than 5 crore, 60 lakh deed.
All shareholders should be the partners of the LLP.
Yes. Yes. Total assets 5 crore. Yes, right. So if you fail to fulfill these conditions, then in that particular case, it will be deemed to be the income of the successor LLP. Clear? So again, you have to look at this particular conditions which are there under that particular section. Are we clear about 72A? Yes or no? Any questions, any doubt? Fine. Next is
Ma'am,
72AA. Yes.
ma'am, speculative business laws will not be carry forwarded, right, ma'am?
Yes. This is for other than
Okay.
speculative.
Okay, ma'am.
Fine. Okay. Similar, we have section 72AA. 72AA is in the scheme of amalgamation of the banking company. So one or more banking company with any other banking institution under a scheme sanctioned by the central government. Now you will say at the 72A also we had this particular banking company covered, isn't it? Here also we had the banking company, but here it's a banking company with a specified bank, and the specified bank here is basically the State Bank of India. So when the bank gets merged with the State Bank of India, but here it is covering all other banking company under the scheme sanctioned by the central government, or with any other banking institution or a company subsequent to the strategic disinvestment, wherein the amalgamation is carried out within 5 years of the strategic disinvestment, or one or more new banks are brought under the scheme which is of the central government, right? Or one or more government company with any other government company. So 72AA is specifically covering all other banks. Under 72A, you have the bank with the SBI, merging with the SBI. In this case also they say the same thing, that the losses and the UAD of the amalgamating company shall be deemed to be the losses and the UAD of the amalgamated company. Under 72AB, you have the cooperative banks being covered. So again here it says that in the case of this amalgamation of the cooperative bank with another cooperative bank, the losses will be carried forward and set off by the amalgamated company. And here they have the same conditions, which is the amalgamating company should have been in business for 3 or more years. It should hold 3/4 of the book value of assets for 2 years. And the amalgamated company should also continue to hold 3/4 of the assets for 5 years. It continues the business of the cooperative bank for a minimum period of 5 years, and it is for the genuine business purpose. Same, it also covers the demerger as well. So the losses in the demerge will be carried by the resulting company. Are we clear? Any questions, any doubts so far? Yes or no? Yes?
Clear, ma'am.
Okay. So now we move towards the next section, which is 79. Okay, 78, sorry. Carry forward and set off of losses in case of change in the constitution of firm or succession. Now, what does this section say? So, this is a very, very important section. What does it try to say is that under 78, where there is the succession of the firm or change in the constitution of the firm, what do we mean by the succession? Yes.
Inherit करना मतलब
Inheritance is one thing.
inheritance.
Yeah. Succession can be by way of inheritance. So where basically you inherit the business, the legal heirs will be taking up the business. There is succession otherwise than by inheritance, which means the other person is taking over your business, right? That's not by inheritance. So what this is, in case of succession by inheritance, where there is a succession by inheritance, the legal heirs are entitled to set off the business loss of the predecessor. And they can carry forward and set off the business loss of the predecessor. But where there is a succession otherwise than by inheritance, so if any other person takes over the business, he will not be allowed to carry forward and set off the losses. Except if it is a case of amalgamation, demerger, conversion of company to LLP, or conversion of partnership firm, sole proprietary firm to a company. If it is any other kind of succession, they will not be allowed the carry forward and set off of losses of the predecessor. Is this clear to everyone? Yes? Next is the change in the constitution of firm. What do we mean by change in constitution of the firm? Change in the constitution of firm means here that where there is change
Partner
in the,
retire.
sorry?
Retirement of partner, admission of new partner.
Correct. So, what they are saying is that in case of the retirement of the partner, right, where there is a change in the constitution of the firm, then the loss attributable to the share of the retired partner, let's say retired partner was holding profit sharing ratio of 1/3. So 1/3 of the loss on account of the retirement of partner or death of partner shall not be allowed to be carried forward by the firm. That means that partner's share of loss shall lapse. Only the business loss, the unabsorbed depreciation can be carried forward without any restriction. Are we getting this point? Yes. So when there is this change in the constitution on account of retirement or death of partner, then the business loss, the share of the business loss of that partner will lapse. Unabsorbed depreciation, you can carry it forward indefinitely without any restriction. Clear? Yes or no? Fine?
Clear, ma'am.
Okay. Now the next section is very, very important section. Section 79A. Now what is this particular section telling us? Understand this is the very, very important section 79A. Sorry, 79. What does it say? Share of business loss as per the income tax or books, income tax deed. Okay. 79 says, 79 is again a specific anti-avoidance regulation, SAR. What does it say? This is applicable in the case of the closely held company. What is a closely held company, students?
Private companies, which is not a openly held company, like
Which is not?
government company,
Yeah.
open held government company, RBI company, NGOs,
Correct.
public sector companies, which are
Correct.
not
In which
others are closely
in which
held.
public do not have substantial interest.
Correct.
Interest.
These are the closely held company, right? Now what they say is they've divided this into two parts. So one is the startup. Okay. One is basically the startup and the second is the other companies. So 79 has been divided into two parts. One is the eligible startup for which they can claim the deduction under 80 IAC. We will see that in the deduction class. Second is the other companies. Now, in the case of a closely held company in which the public is not substantially interested and which is not a startup, normal company, the loss which is incurred in the year shall be carried forward and set off in the next year only when it satisfies one condition. What is the condition? That in the year in which the losses are incurred, in the previous year in which the losses are incurred, the shares should be held by the people who are holding more than 51% of the voting power. And when you set off the losses in the next year, right, you're carrying it forward in this year and you set off the losses in the next previous year. So in the previous year, when you set off the brought forward losses, the people who are holding the 51% in the year of incurrence of loss should be the same people who are holding now 51% in the year of set off. Are we getting this particular point? So what they are trying to say over here is that when you claim the set off of the losses, right, it shouldn't happen that the companies now are selling their stakes to other people in order to just claim the set off of the losses and then sell that company. So in the year in which they incur the loss, there are some people, and in the next year, there are other people coming in. So indirectly, the company has sold or the shareholders have sold the company. Are we getting it? So here they have introduced this particular condition. Let me explain you with the help of an example. Let me know if the screen is visible. So what they are saying is that the shareholders beneficially holding greater than equal to 51% of the voting power should hold as on the previous year in which the loss is incurred and as on the previous year in which loss is carried forward and set off. So let's say ABCD Limited is there. In 15-16, it had no loss, only UAD. In 16-17, it had no loss, only UAD. And in 17-18, it had a 9 lakh business loss, as well as UAD. Now, in the 17-18 previous year, the A sold the shares to Y. And 18-19, B sold the shares to Z. Right? Now, profits for the previous year 17-18 are 15 lakh before depreciation of 9 lakh. And 18-19, it is 45 lakh before depreciation of 7.5 lakh. Now, A, B, C, D are having the equal voting rights. Correct? So, in 14-15, they are having 25, 25, 25, 25, 100%. 15-16, they have 25, 25, 25. 16-17, they have again 25, 25, 25. 17-18, A sells to X. Right? They have incurred the losses in 17-18. Correct? In 17-18, who are the shareholders holding more than 51%? Yes?
B, C, and D.
B, C, and D. Correct? Now, in the year 18-19, when you want to set off, are they the same? In 18-19,
No, ma'am. B has sold its
to
shares to the
Y.
Y, so there is less
Correct?
than 50%. C and D only 50%.
Correct. So they will not be allowed to set off and carry forward the losses. So in the year of 18-19, C, D, X, Y become the beneficial owners. Now C and D combined are holding only 50%. Isn't it? So what they say is that the unabsorbed loss can be carried forward and set off only when more than 51% of the shareholders who were beneficially holding the shares as on the year of incurrence of loss are same in the year of set off of loss. If B would have continued to hold even in 18-19, they would have been able to set off and carry forward the losses. Are we clear? Yes or no?
Yes, ma'am.
Ma'am,
Okay. Yes.
in 1819, B was holding the 25% shares, then they will be eligible, right? Then in the
Yes.
year 1920, if then B has sold the shares in 1920 next year,
Yeah.
then they will be allowed, or they, since B has
Will
sold
not
it
be
is less
allowed.
than 50%,
So in the
it will be
year in
considered.
which you want to set off, you have to again check the condition. So this is the condition you have to check every year when you are setting off the losses.
Okay.
Clear? Now this is applicable for the other companies. In the case of the startup, In the case of the startup, what do they say? It says in case of an eligible startup, there is no condition of the 51% per se. There is no condition of the 51 that they have kept over here. What they are saying is that you have two conditions. Either you can, as on the last year of the previous year, those who are holding 51% in the year of incurrence remain 51% in the year of set-off. The same condition for the other company. Or all the shareholders who held the shares carrying the voting power on the last year of the previous year in which the loss was incurred continue to hold those shares in the year of set-off of the loss, and such loss has been incurred during the period of 10 years beginning from the year of incorporation of the company. So what do they say is basically that all the shareholders as on the last day of the previous year in which loss is incurred and the year in which the loss is set off should remain the same. Now, what does this mean? Let me explain with an example here. A, B, C, D, X, Y, same example. 18, 19, 25, 25, 25, 19, 20. A sold 5%, B sold 5%, C sold 5%, D sold 5% respectively to X and Y. So X got 20, Y got 20. 2021, A is holding 5, B is holding 5, C is holding 5, D is holding 5, X and Y got to 40, 40. Losses were incurred in 18, 19. Can you set off in 19, 20 and 2021? If it is an eligible startup?
Yes, sir.
Yes.
In 1920, 51% is also satisfied.
Correct.
2020, 2020.
Yes. In 2020, 21, even if the 51% is not satisfied, but all the shareholders who were there in the year of incurrence of loss are also present in the year of set-off of loss. So even then, the condition gets satisfied. Are we clear? Do you understand the difference between the startup and the normal company? Yes? Yes or no, students?
Yes, ma'am. So in
Okay.
2021, just they have to be in startup, they have to be the shareholder of that company. It doesn't matter
Correct.
what percentage it is.
Correct.
Even if they hold one share, then
Correct.
also
Share of-
they are eligible.
Yes. But it should be
Okay,
seen that the losses have been incurred within the 10 years of the incorporation of the company. If the losses are after 10 years, then this condition is not applicable. Clear?
Clear, ma'am.
Any other question? Any doubt? Okay? Fine. Now, there are certain exceptions to this particular 79. Where the change in the voting power and shareholding takes place consequent upon the death of the shareholder or on account of transfer of shares by way of gift to any relative of the shareholder making such gift. So basically 79 is not applicable in respect of the gift of shares of the to the relative of the shareholder or on account of the death of the shareholder, or where the shareholding changes on account of there is a change in the shareholding in Indian company which is a subsidiary of a foreign company as a result of amalgamation or demerger of the foreign company. Subject to the condition that 51% of the shareholders of the amalgamating or demerged company should remain the shareholder of the amalgamated or demerged company, resulting company. So basically, if the shareholding of the Indian company, which is a subsidiary of the foreign company, this company's shareholding change because its parent company is now getting amalgamated or demerged with the another company. However, if more than 51% of the shareholders remain the same at the top, the losses can be carried forward of the Indian company. In case of the change in the shareholding taking place pursuant to the resolution passed under the Insolvency and Bankruptcy Code. So, if the case moves under the resolution plan approved under the IBC, or in case of a company where the application has been moved by the NCLT because of the change in the shareholding, and the resolution proceedings in respect to this bankruptcy are again approved by the NCLT, right? In these cases, the 79 is not applicable. Or relocation of a capital asset, so where the change in the shareholding has taken place on account of relocation of the capital asset by the original fund to the resulting fund. You would have seen that in the capital gain class also. Or in case of the erstwhile public company, where there is a strategic disinvestment happening, subject to the condition that the ultimate holding company of this erstwhile public sector company continues to hold 51% of the voting power. So in these cases, 79 is not applicable. Any questions, any doubt till now? Yes? Fine? Yes or no, students? Okay. Next is section 79A. 79A says that there will not be any set-off of losses against the undisclosed income brought to tax consequent to search, requisition and survey. So you will see this again in the assessment class also, where any income is brought to tax because of search conducted. Now that income is taxable on the gross basis because this is an undisclosed income, right? And when the search is conducted, survey is conducted, and they find certain, this thing, what do we say? The valuable assets. In those cases, there will not be any set-off of loss. Okay. Any questions, any doubt? Yes?
No, ma'am.
Okay, so in these cases, UAD brought forward losses will not be allowed to be set off. Fine? Yes or no? Shall we revise once? Yes? This particular chapter. Okay, let us look at once. I have made this summary chart for you. Let us look at one. So first, we will do the inter-head adjustment, inter-source, right? Intra-head adjustment. For IFHP, you can first set off under within the head under 115 BAC, right? You cannot set off the SOP losses against the even the house property income. So you can write it over here. 115, or wait, let me write it over here. No set off of SOP loss. What about the LOP, DLOP?
Current year losses can be shut off against the income, but it cannot be carry forwarded.
Correct. So LOP, DLOP, current year losses can be set off against the same head. You cannot do the interhead. Yes or no?
Yes, ma'am.
Correct? Under the normal business income, you can set off against the other head, but only up to the limit of rupees 2 lakh. Balance you can carry it forward for 8 years, and the next year you can carry it forward again, set off against the same head of income. Filing ROI before the due date under 139(1) is not mandatory for claiming the house property loss. So even if you file the belated return, you can still claim the house property loss. Coming to the normal PGBP, you can do the inter-source set-off. You first then inter-head except against the salary, carry it forward for 8 years, and next year it can be set off against PGBP. But here filing ROI is mandatory. When it comes to 115 BAC income, which losses we can't claim?
Additional depreciation.
That is UAD, not PGBP.
Scientific research.
Correct.
Scientific research.
Scientific research relating to the payment
Outsource.
to outsiders.
Outside.
When it is in-house contribution, you can claim the scientific research and even losses in relation to that. 73 is speculation. Same source, you can only do it with against the speculation profit. You cannot adjust against any other head. It can be carried forward for 4 years, again then set off against the speculation profit only. But here filing ROI is mandatory before the due date under 139(1). 73 is specified business loss. You can again only set off against the specified business income. You cannot set off against other head. This can be carried forward and set off indefinitely. Fine? Yes or no? But here again, the return of income has to be filed on time. Here, this cannot be claimed under section 115 BAC. Fine? 32(2) unabsorbed depreciation. So this can be carried forward indefinitely. You can set off against any head of income except salary, even in the future years. Return filing before the due date under 139(1) is also not mandatory. However, under 115 BAC, what happens?
Additional depreciation.
No allowance for UAD relating to additional depreciation. Short-term capital loss, you can set off against the LTCG, carry it forward in the future years. For 8 years, you can set off against STCG, LTCG in the next year. LTCL, you can only set off against LTCG. Right? Owning and maintaining, you can only set off against that. Clear? And these can be carried forward for 8 years and 4 years respectively. This is the order of set off. First, current year depreciation, current year scientific research and family planning capex, then brought forward business loss, then UAD, unabsorbed scientific research and unabsorbed family planning expense. Clear? We understood what is 72A. These are the eligible companies: industrial undertaking, merging with another company, hotel, ship. This is merging with a company. What is industrial undertaking? Manufacturing, processing of goods, computer software, generation and distribution of electricity, telecom, mining, construction of ship, aircraft, railways. Banking company with the SBI. Public sector company, erstwhile public sector company with the another company. This is for the remaining period of 8 years. Amalgamating company, the conditions are: remained in business for greater than or equal to 3 years, holds 3/4 of the book value of fixed assets for 2 years. Amalgamated company continues the business of amalgamating for 5 years, holds 3/4 of the book value of assets of amalgamating company for 5 years, achieve 50% of the production capacity before the end of 4 years from the date of amalgamation. For a period of 5 years, they have to maintain that minimum level. If they do not fulfill these conditions, then it will be the income, the losses and the UAD will be income of the amalgamated company in the year of non-compliance. 72A, this in relation to the demerger. Then we saw that it can be again set off for the remaining period. Conversion of partnership firm, LLP, sole proprietary to company or company to LLP, losses will be deemed to be the losses of the successor for, sorry, now this is not fresh period, this is remaining period. Okay. This is also remaining period. And in case you do not comply with these conditions, then it shall be deemed to be the income of the successor company. And then we saw the 79. Is this clear, students? Any questions? Any doubt? Yes.
Ma'am, with respect to unabsorbed depreciation, it can be adjusted against any other head other than the salary. But
Right.
whether it is allowed for short term and long term capital loss also, gain also.
Yes. Yes, you can.
Okay,
Unabsorbed depreciation you can.
okay, on the subsequent year also.
Yes.
Okay.
Unabsorbed depreciation every year you can because it is deemed to be the current year depreciation.
Okay, it can be set off against any other income other than salary and subsequent year
Correct.
also. Okay, fine.
Fine. Okay. So this completes your set off and carry forward chapter. So what we will be doing is now we will be starting. Okay, there are a few cases that I have to discuss. There are two cases that we need to discuss from this particular chapter, and then we'll take a break and we'll start after the break with the chapter 60 reduction. So the one case law is, can a resulting entity set off and carry forward the losses of the dysfunctional unit of the demerged entity? So what does this mean? So demerged is defined as that it should be a demerged according to the Companies Act, wherein the undertakings are transferred on a going concern basis, like as an ongoing business. It should not be a business that is no more which can be continued. So here the assessing officer's contention was that the assessee was not eligible to claim the benefit of the brought forward losses for the reason that the undertaking which was transferred was not an independent unit of which the business could be carried on. It was dysfunctional. So it does not qualify to be a going concern. Because 219 AA, which defines the demerger, says that the undertaking should be transferred on a going concern basis. Since it is not transferred on a going concern basis, it's not demerger, and therefore 72A doesn't apply. So here the Supreme Court noted that the going concern only means that the transfer should be on going concern basis. It doesn't mean that the undertaking should be a going concern as on the date of transfer. Looked into the scheme of demerger because the scheme of demerger has to be approved by the NCLT or by the court. It was approved. And they saw that all the assets, all the liabilities, all the employees, all the obligations, rights of the undertaking were transferred in the course of the demerger. This is a going concern only. It doesn't mean that the entity should be able to continue its business independently. It just means that everything that the entity has, the undertaking has, should be transferred. So let's say, for example, if tomorrow I am having a CA firm, I am having two operations. One is the audit segment, second is the advisory segment. Now, if I hive off the advisory segment and put it into a new company, that is a demerger. Because what I am doing when I am hiving off, I will transfer the contracts of my advisory business. I will transfer my chartered accountants, lawyers who are working on the advisory segment. I will transfer the receivables of the client fees in that new company. I will transfer any expense payable into the new company. That is a demerger. I am transferring it on a going concern basis. So even if this entity was not functioning, this undertaking was not functioning at the time of demerger, the Act says it should be transferred in a going concern basis. It doesn't say that the undertaking should have been a going concern at the time of demerger. So the Supreme Court held that if a unit is running and profitable, Why would somebody demerge? Here, this is transferred with the employee's assets, debt, obligation, rights. Therefore, this is transferred on a going concern basis and there is no problem. Are we clear? So here the set off of losses were allowed by the court. Are we clear? Any question, any doubt? Next is, yes.
I have a question. Does only transfer of assets to another new company, does the tantamount to demerger if only assets are transferred?
It doesn't. All the assets and liabilities should be transferred, not just assets.
Right.
Okay. Next is Delhi High Court decision, which the question was, can the loss suffered by the partnership firm, which was dissolved, can be carried forward by the individual partner who took over the business of the firm as a sole proprietary, considering the succession as a succession by inheritance. So here the question was that the partnership firm was dissolved and one of the partner took over the running business as a sole proprietor. And this was not the case by succession by inheritance. Hence, the carry forward and the set off of losses were not allowed. So here there was another case of Supreme Court where the sole proprietor had expired. And after his death, his legal heir carried on the business into a partnership firm. Now, this was a case of succession by inheritance. So losses suffered by the proprietor, the predecessor, can now be set off by the partnership firm because this was a case of succession by inheritance. Right? If the partner died and his legal heir, who was one of the other partners, carried on the business as a sole proprietor, that is a case of succession by inheritance. In this particular case, the partnership firm was dissolved and one of the partner who was not a legal heir carried the business. Therefore, in this case, it is not a case of succession by inheritance and the losses will not be allowed. Clear? So these were the two cases from your module that I wanted to discuss. And that's all we have for the set off and carry forward of the losses. Now, after this, we will start with the chapter 6A deduction. So we'll take a break here for 10 to 15 minutes. We'll get back and we'll start with the chapter 6A deductions. Is that fine? Let's take a break here for 10 minutes. Okay. Chapter 6A deductions. Let me know once the screen is visible to you. Okay. Now we are going to divide here, students, the deductions into two segments. Okay. One is the normal investment based deduction. Second is the deductions based on the total income. Okay. So one kind of deductions is the deductions based on the investments that you make. The second kind of deductions are the deductions on the basis of the income, which are called as the income-based deductions. So the investment-based deductions which are there, students, is mostly like, ATC, ATD, all of these sections. However, the deductions which are in the nature of the income-based, that is basically concerning the deductions which are to incentivize a particular sector of income. Okay, so let me show you this. So there are investment or expenditure based deduction. For example, ATC, ATCC, ATCCD, ATCCE, right? These are my investment based deduction. Like for example, you put for LIC, you put for Mediclaim. Second is the expense based for medical premium, for the disability medical expenditure, some special deductions, interest-based deduction, ATE, ATEEA, EEB, contribution-based to the political party, donations and all of that, ATG, GGA, rent payments under ATGG. Then you have income-based deductions, ATIA, ATIB, ATIE, ATLA, ATM, ATP, ATPA, 10AA, all of these are the expense-based deduction. Now, coming to the point that what are the deductions which are allowed under the concessional tax regime? Can you tell me what are the deductions which are allowed under the concessional tax regime?
ITCC D2 employer contribution to NPS up to the 14% of the salary.
Yes. Next.
Agniveer contribution दो ही याद है
ATLA, ATJJAA, ATM. So these are certain deductions which are available under the concessional tax regime. We'll see that. Okay. So first we'll start with this particular topic. So first is section 80A. 80A 1 provides that in computing the total income, you will allow the deductions from the gross total income under ATC to ATU. So basically, 80A gives you the mandate that from the gross total income, you can claim the deductions under ATC to ATU. And 80A2 says that the aggregate amount of deduction shall not in any case exceed the GTL. So obviously, your deductions will be restricted to the GTL. It cannot be more than the GTL. Right? Your GTL cannot turn negative because of deduction. If you have a loss, then obviously you can't claim the deduction. Right? You can carry forward the loss and set off in the subsequent year, but you can't claim the deductions again that. 80A3 provides that in the case of AOP or BOI, if any deduction is admissible under ATG, GGA, GGC, IA, IB, ID, IE, no deduction will be allowed to the member of the AOP or BOI in relation to the share of the member from the AOP or BOI. So once the deductions are allowed to AOP or BOI, the member again can't claim. Right? Then the profit and gains allowed as deduction under 10AA or under any provision of Chapter 6A under the heading Chapter 6A deduction in any assessment year shall not be allowed as deduction under any other provision of the Act for such assessment year. So you can, if you have claimed deduction under ATC in relation to incomes, then obviously you cannot claim the same deduction under any other chapter. For example, if you have claimed a deduction under ATIA, IB, you cannot claim then 35AD. Right? And it says that the deduction which is there shall not exceed the amount of profits of the undertaking which are there. So the deduction again will be restricted to the income-based deduction, the profit-linked deduction, the deductions which are available in respect of the profits from that particular business will be restricted only to the extent of profit. And for this, claiming these profit-linked deductions, you have to claim the deduction in the return of income. It is mandatory to file the return of income. Further, what they say is that in case of the undertaking or a unit for which you are claiming the profit-linked deduction, if they transfer the goods to any other undertaking or unit or any other business of the same assessee, that transfer has to be at the market value. Right? Because it is possible that you may shift the profits from the undertaking which is eligible for deduction under ATIE, ATIB to any other undertaking which is not eligible for deduction under ATIE, ATIB. Are we clear? Then again it says where a deduction under this particular section is allowed, no deductions under 35AD will be permissible in respect of that particular income. Next is section 80AB. It says that for the purpose of calculating the profit-linked deduction, this alone shall be regarded as the income and should be included in the gross total income as the only income. So basically what it means is the profit-linked deductions which are there are only available with respect to the profits from those undertakings. We'll see that in detail. And ATSC says that in respect of this profit-linked deduction, furnishing the return of income on or before the 139(1) due date is mandatory. Clear? Are we clear up till now? Yes or no? Yes or no? Fine. And when you reach to GTI here means the deductions, the GTI here means your income, clubbed income of any other person, any set off and carry forward of the losses, any unabsorbed depreciation. After that, what you get is the GTI. From that, you will claim the deductions. Clear? So let us start with the first deduction, which is ATC. ATC provides for the deduction from the GTI of saving in specified mode of investments. ATC is available only to an individual or HUF. And this is available only when you opt out of the default tax regime. It is not available under 115 BAC. What are the deductions available under ATC? Contribution in the unit-linked insurance plan in the name of that individual or his spouse or the children of that individual. And in the case of HUF can contribute for any member. What is unit-linked insurance plan? Unit-linked insurance plan is ULIP. So basically where you take the insurance, but that insurance amount which is there is linked to the market units. Or the unit-linked insurance plan of LIC mutual fund. Right? Secondly, premium paid in respect of the life insurance policy, where the individual pays the LIC premium for either his own self, for his spouse, for his children, whether major or minor, or where the HUF pays for any member. You will get the deduction under ATC. Now here, there is a condition which is attached. What is the condition? So they say that in respect of the policies, which are issued on or after 2013, where the insurance is in respect of a life of a disabled person or a person who is suffering from the specified disease, the maximum premium should be to the extent of 15% of the sum assured. And in case of any other person, it should be to the extent of 10% of the sum assured. Sum assured meaning what is the amount that you're going to get. If you pay more than that, you'll not be eligible for deduction under ATC. Plus, what will happen, students? If you pay premium more than that, what happens? Yes. You would have seen that in the IFRS
No
class.
exemption under 1010D.
Correct. And what is the limit for that?
2 lakh.
No.
2,50,000.
No. Isn't that for ULIP?
5 lakh, I think. 5 lakh.
Correct. It is 5 lakh rupees. Right? And if you receive the amount under which head it is taxable? Yes?
Income from other sources.
Correct. So, in respect of the payment, in respect of LIC, if your premium paid is more than 5 lakh, plus it is more than 10% of the sum assured, then this is taxable under income from other sources under 56. Yes or no? If it is less, then of course you will get the exemption under 1010D. In respect of the contribution to the ULIPs, the limit of the premium is 2.5 lakh and premium is 10%. Then ULIP is regarded as a capital asset under 214. So if it is more than 2.5 lakh, it will be capital gain under 45(1)(b). Yes or no? Yes? You would have done this? Yes?
Yes, ma'am.
Fine. So this is how you have to link and study. Okay? Next is premium paid in respect of contract for deferred annuity. So any premium paid for a deferred pension on the life of the individual, like after his death, his family will get, or for his spouse, or for his children. Right? So that is also eligible for deduction under ATC. Any sum deducted from the salary of government employee for such deferred annuity is also basically allowed as a deduction under ATC. Clear? Up to the 1/5 of the salary. Then contribution to statutory provident fund, public provident fund, recognized provident fund is allowed as a deduction under ATC. Yes? Next is contribution to the approved superannuation fund, sum paid in Sukanya Samriddhi account in the name of any girl child of the individual or for any girl child of whom he is a legal guardian. So this is eligible for deduction under ATC. And then any payment received from Sukanya Samriddhi account is also exempt. Any interest on that account is also exempt. Subscription to the NSC, contribution to approved annuity plan of LIC, subscription towards the units of mutual fund, tax saving mutual funds or UTI, contribution to notified pension fund set up by the mutual fund or any UTI, contribution to National Housing Bank tax saving term deposit scheme, any tax saving FD that you take, subscription to the deposit scheme of public sector company which is engaged in long-term finance for construction of or purchase of houses for residential purpose, payment of any tuition fee for 2 children of the individual, for any university, school, college, educational institution within India. Right? Repayment of housing loan, including the stamp duty, registration fee, other expenses, the income of which is chargeable under IFHB. Right? So that is also allowed under ATC. Then what is here inadmissible is admission fee, cost of initial deposit with respect to the cooperative society, repairs of the house after you get the possession of the property, any interest expenditure which you have claimed under section 24, those are not what you can get. Subscription to the equity shares or debentures which are issued by a public company. Right? So, however, there is a lock-in period of 3 years. If you sell the shares or transfer the shares or debentures within the 3 years, the deduction allowed earlier shall be deemed to be the income in the year when you sell it. Subscription to certain tax-saving mutual funds. Investment in tax-saving FDs. Right? With any banks. Subscription to the notified bonds issued by NABARD, Senior Citizen Savings Scheme, Post Office Time Deposit, contribution to the NPS, right? Which is again for a minimum period of 3 years. So, all of this is covered under ATC. Clear? And the maximum period, the maximum deduction is 1.5 lakh. Now, what happens if you terminate your LIC, ULIP, or you transfer the ULIP, if you terminate your contract of insurance for which you have been claiming the deduction under ATC? Let's say if you are not paying the premium after the 2 years of commencement of insurance of which you are claiming the deduction under ATC. Or you terminate your ULIP by not paying the monthly SIP of that. For a period of 5 years, you have to pay it. Or let's say if you have purchased the house and for which you have claimed the stamp duty deduction, registration charges deduction, or you have claimed the principal amount of the loan as deduction, and you're transferring the house property before the expiry of 5 years from the end of the financial year in which you have taken the possession. Right? Then in that particular case, the deduction which have been allowed earlier now will be deemed to be the income of the year in which you violate or you fail to provide the contribution or you sell the house. Or if you withdraw the amount from Senior Citizen Savings Scheme, Post Office Time Deposit, before the expiry of 5 years, the amount withdrawn shall be deemed to be the income. Are we clear? Any questions? Any doubt? Yes or no? Yes? Fine, is this understood? This is very simple. Okay? Any questions? Any doubt? Yes? Fine? Yes or no? Okay. Next is deduction in respect of contribution to certain pension funds, 80CCC. So where an assessee being an individual has in the previous year paid or deposited the amount out of his income chargeable to tax to effect or keep in force and contract for annuity plan of LIC or other insurance for receiving the pension from the funds set up by LIC. So if they contribute to any pension funds, again here the maximum deduction will be 1.5 lakh. Now remember this, the maximum deduction which is given is 1.5 lakh. And when you surrender this pension fund, so any amount which is surrendered when you surrender this pension fund, the amount standing in that particular account, in the pension account, together with the interest or bonus which is accrued, right? This will be deemed to be the income of the assessee in the year of withdrawal. Are we clear? So 80CCC, which is there, is providing you the deduction for the amount contributed to the pension fund. So if you receive any pension or if you withdraw the amount from the pension fund on surrender of the policy, this is going to be treated as the income. Clear, students? Yes or no? Fine. Okay. Next is, again, this deduction is available only under normal tax regime. This is not available under 115 BAC. Next is contribution to the pension fund notified by the central government. Now, employees' contribution to the pension fund. How much is available under 80CCD? Yes. So under 80CCD, employee contribution is 10% of the salary or whatever amount you deposit. So maximum up to a 10% of salary is allowed under 80CCD. Right? The employee contribution to the NPS. Now this is available only under the normal tax regime. This is not available under the concessional tax regime. Right? This is not available under the concessional tax regime of 115 BAC. Fine. Then the employer contribution. Employer contribution which is there. The employer contribution which is there is again provided under 80CCD 2. The employer contribution is provided under 80CCD 2. So in case of contribution made by the central government or the state government, the employer contribution is restricted to 14% of salary, which is basic plus GA. In case of any other employer, it is restricted to 10% of salary. However, if you go for 115 BAC, this becomes 14%. So, this is 14% under section 115 BAC for any other employer. So, 80CCD 2 is available under the old as well as the new regime. Are we getting this? So this is allowed under old and default regime. Okay. Plus under 80CCE, there is a maximum cap of 1.5 lakh for every deduction for 80CCD 1, which is the employee contribution. For the 80C, 80CCC, the maximum is 1.5 lakh. However, this employer contribution is not capped by 80CCE limit. Are we getting this particular point? Yes or no? So 1.5 lakh limit is not applicable on the employer's contribution to the pension scheme. Fine? Yes or no? Any questions, any doubt? And finally, you have the NPS, your additional contribution, self-contribution, which is 50,000 under 80CCD 1B. Again, this is not capped by 80 CCE limit of 1.5 lakh. However, this is not available under the 115 BAC regime. Also, a self-employed individual can contribute up to 20% of GTI under 80 CCD, but 80 CCD1. However, that is also not available under 115 BAC. Only 80 CCD2 is available under 115 BAC. Now, when you withdraw the NPS, okay, when you withdraw from the NPS, let's say if you are closing the account of the NPS or you are opting out of the NPS, right? So in that particular case, 40% of the amount is taxable, 60% gets exempt. Are we clear? So not the entire amount is exempt. So on the closure or opting out, the amount is partially exempt. So up to 60% it is exempt. 40% will be taxable on the closure of the account. If you do a partial withdrawal, right, any employee is partially withdrawing, then 25% of the amount which you are withdrawing is going to be exempt, balance 75% will be taxable. And if it is any other person who is withdrawing, entire amount is taxable on partial withdrawal. However, if you are withdrawing the amount on the death, so basically if a nominee withdraws the amount on death of the person, it is not taxable. Clear? Any questions, any doubt? Yes? Fine? So this is what is the 80 CCE saying, 80C, 80 triple C, 80 CCD1, 10% of the salary or 20% of the GTI. All these three are subject to a maximum limit of 1.5 lakh. 80 CCD1B, additional 50,000. 80 CCD2, for a government employee 14%, for others it is 10%. If you go for 115 BAC, for others also it is 14%. This is over and above 1.5 lakh. Yes or no? Any questions? Any doubt? Will you solve a question on this? Okay, let us look at this. The basic salary of Arjun is 1 lakh per month. He is entitled to DA, which is 40% of basic salary. 50% of DA form part of the retirement benefit. Both Arjun and his employer contribute 15% of salary to pension scheme under 80 CCD. Examine the tax treatment in respect of such contribution in the hands of Arjun if he has exercised the option of shifting out or if he pays under the default tax regime. What will your answer be? Yes? Yes, please.
We have to calculate first salary, 1 lakh per month. It is basic 1 lakh per month into 12 lakhs, and then 40% of the salary, and within that 50% is forming the retirement benefits. So 12 lakhs into 40% into 50%. So it will be 2,40,000. So his salary contribution, total salary for this calculation will be 14,40,000. for that, maximum, since he is not a government employee, maximum, if it is opting out of default regime, maximum 10% of the salary will be allowed as deduction under ITCCD. So 14 lakhs 40,000, 10% is 1 lakh 44,000. So it will be allowed, and remaining amount will be taxable. And if he is in 115 BAC default regime, then it will be the 14% of 14 lakhs 40,000 will be exempt, and remaining will be taxable.
Correct. So here, if you look at it, plus there will be also the ATCCD 1B also will be available. So here the employer contribution would be treated as a salary since it is specifically included in the definition of salary, right? So basic is 1 lakh into 12, 12 lakh. DA is 40%, 4 lakh 80, out of which forms the part of retirement benefit is only 50% of DA, which becomes 240. So salary for the purpose of ATCCD is 12 lakh plus 240, which is 14 lakh 40. Now, the deduction under this particular section, which is available, is 10% of the 1440 because he is not government employee and he is opting out, right? Out of the 15% of basic salary. So deduction is restricted only to 10%. So plus a further deduction of 50,000 will be allowable. So how will you calculate a further deduction of 50,000? So 1 lakh 80 is the total that you are making out of 12 lakh, right? 15% you're contributing, out of which 144 I have here already claimed. So I will claim 36 under 80 CCD B1B. Clear? Okay. So this is coming to 36,000. So 144 is allowable as a deduction under ATCCD 1 and this is subject to overall limit of 1 lakh 50 and plus you will get 36,000. Did you understand how did we arrive at 36,000? Don't forget this in examination. Don't forget this in examination. You will only claim 144 but you can also claim additional 50. But I will not claim entire 50 because my exact contribution to NPS is how much? 180. So here they have said my contribution to NPS is 15% of basic salary. Don't take 15% of basic plus DA. Contribution is how much? 15% of basic, which is 180. Out of which I am only getting 144 in 1. I can still claim 36 in 1B. Because here 50,000 additional limit I am getting. Is this clear, students? Yes or no?
Clear, ma'am?
Yes. Okay. Now, under the new tax regime default under 115 BAC, I will get additional 14%. Right? So here I will get the entire 180. So I have contributed
limit of 80 cc is not applicable in case of contribution in NPS by employer, any employer.
Correct.
Is that correct?
Yes.
Okay.
It is not applicable under 150 limit. Employee contribution is subject to 150. Employer contribution is not subject to 150. Fine.
Yes, ma'am.
So Arjun's own contribution. See, here what you are getting is what they are saying, the employer contribution would be first treated as a salary. Employer contribution. So 180 will be included in the Arjun's salary. Now Arjun's own contribution to pension fund is allowed as ATCCD 1. This is subject to 1 lakh 50. Clear? This will remain the same either under the default tax regime and under the old tax regime. Under the default tax regime, this is not available. Correct? Under default tax regime, Arjun's own contribution would not be eligible for ATCCD 1. Yes or no? contribution is concerned, so this we have computed Arjun's contribution. Right? The employer's contribution to the pension scheme would be also allowable as a deduction under 80 CCD 2, which is maximum of 10% of my salary. Therefore, a further deduction of 1,44,000 will be available for the income which is included under 1718. This is over and above 1.5 lakh. This is not covered under 1.5 lakh. So we are getting 3 deductions for this. First, this 180, which is the employer contribution, which is 15% of basic, is included in my income. Then I am getting deduction of my contribution to the NPS. The balance amount, which is not covered under 80 CCD 1, because 80 CCD 1 allows me 10% of basic plus DA. I will get under 80 CCD 1B, which is over and above 1.5 lakh, which is restricted to 50,000. So I'm getting balance 36,000 over here, because the actual contribution that I have made is 180 only. Correct? Then I'm also getting the employer contribution as deduction under 80 CCD 2. Under a default tax regime, I will not get the deduction for my own contribution. I will not get the deduction under 80 CCD 1B. I will get deduction of the employer contribution, which is 14% of the salary, which is basic plus DAR, which comes to 2,01,600, but which will be restricted to actual contribution of 180. Is this clear, students? Yes or no? Clear? Okay.
Clear.
Fine.
Yes, ma'am.
Let us proceed further. Deduction in respect of contribution to Agnipat scheme, APCCH. This is a new scheme framed by the central government for armed forces. So, the contribution in this Agniveer corpus fund, if you contribute, you will get a deduction under 80 CCH for the amount deposited into this particular Agniveer scheme. And this is available both under the new as well as the old scheme. And any amount that you receive from this is also exempt. Clear? Very simple. Next is medical insurance premium 80D. Okay, under 80 CCH, it is entire contribution which is allowed. No limit, huh? Under 80 CCH, there is no limit for this. Next is medical premium. Now, in the case of the individual, you get the deduction for the medical premium that you pay. Now, what is it covers? Medical premium paid for the insurance of your own self, for your spouse, and for only the dependent children. Under LIC, even if the children are independent, you will get the deduction. Right? Under LIC, major, minor, independent, dependent, both children are covered. However, for the medical premium, only the dependent children. Right? And this contribution should be paid otherwise than by the cash. Right? Otherwise than by cash. So cash medical premium is not allowed as the deduction. Fine. Then preventive health checkup. Anything. When you go for regular checkup, any test, anything. Right? So preventive health checkup, you get a deduction of ₹5,000 rupees. This can be paid in cash. Again, this can be for self, for spouse, or for only the dependent children. Right? Now, this is the deduction that you get is 25,000, which includes the 5,000 for preventive health checkup. 5,000 is not over and above 25,000. This is covered within 25. So the maximum cap is 25,000. However, if you are a senior citizen, meaning you are more than 60 years or more, and you are a resident of India, you get additional deduction of 50,000. Not additional, you get the limit is for you 50,000. Right? The limit for you is 50,000. Plus, you will get the additional deduction for any premium paid for your parents. So, this is 25,000 or 50,000 if you, your spouse or your children are senior citizen, dependent children. Then you get the deduction of 50,000. Otherwise, you get 25,000 for your own self, spouse or dependent children. Plus, if you are paying the premium, otherwise than in cash, for your parents, right? Then you get additional 25,000. If your parents are senior citizen and resident of India, you get 50,000. And this includes the 5,000 for the preventive health checkup. Are we clear? Now this 5,000 is not additional 5,000 that you will get. The total preventive health checkup is 5,000 for either yourself or for your parents. It is not that you will get the 10,000 as the preventive health checkup. Preventive health checkup combined is 5,000. So for preventive health checkup, either for your own self or for your parents or for your spouse or for your dependent children is total 5,000. And this is subject to overall limit of 25 and 50,000. But you will get the deduction of 25 or 50,000 additionally for your parents. Clear? And in case you do not have the medical premium for your parents. If you do not have the medical premium for your parents, and if you incur the medical expenses for them, or for your spouse, or for your own self, who are more than 60 years, and who are resident of India, and for whom there is no medical insurance there, then you will get the deduction of 50,000. So even when you don't have the medical expenses for your own self, for your spouse or for your parents, but you are incurring a medical expenditure, then you get the additional deduction of 50,000. Right? So either you can claim medical premium reduction or you can claim the medical expense reduction. Any questions, any doubt? Yes or no?
Ma'am,
Yes.
if I have medical insurance for myself and if I am occurring a medical expenditure for my parents, then I can claim for my parents under medical expenditure, right, ma'am?
Sorry, I didn't get the question.
अभी मेरे सेल्फ के लिए तो मेरा मेडिकल इंश्योरेंस है मैम, लेकिन पेरेंट्स का मेडिकल इंश्योरेंस नहीं है और मैं पेरेंट्स के लिए मेरा कोई मेडिकल एक्सपेंडिचर हुआ है तो वो मैं क्लेम कर सकता हूँ.
करेक्ट.
राइट.
करेक्ट. सो खुद का मेडिकल प्रीमियम एंड पेरेंट्स का मेडिकल एक्सपेंडिचर, अगर उनका प्रीमियम हमने नहीं निकाला है तो, अगर वो प्रीमियम में मैंने उनके लिए प्रीमियम पे किया है प्लस मैं मेडिकल एक्सपेंस भी कर रही हूँ तो वो नहीं मिलेगा. राइट.
मैम एक और डाउट है, अभी कंपनीज जनरली एम्प्लॉयज के मेडिकल इंश्योरेंस लेते हैं ना मैम, क्या वो भी क्लेम कर सकते हैं क्या मैम? यहाँ पे सैलरी सर्टिफिकेट में दिखा रहे हैं तो पे स्लिप में।
Sorry, there was, I think, some again network glitch. Sorry, I lost you in between. Yes.
अभी एम्प्लॉयर है जिसको एम्प्लॉय के लिए मेडिकल इंश्योरेंस लेते हैं ना मैम, प्रीमियम भरते हैं, और वो लोग सैलरी सर्टिफिकेट में भी सैलरी में से
Correct.
डिडक्शन करके दिखाते हैं कि आप लोगों का मेडिकल प्रीमियम हम लोग भर रहे हैं करके। क्या
Correct.
वो भी इसके नीचे क्लेम कर सकते हैं मैम?
Correct. Yes, you can claim.
ओके।
Because see, you are not directly paying it to the insurance company, but from the salary you are paying. So indirectly आपको salary तो मिला ही है, आप salary तो पूरा ही दिखा रहे हो, right? So उसमें से आपका जो salary use हुआ है to pay the premium for you, you can claim that.
ओके, थैंक यू।
Yeah. So this is something which you can claim as a deduction, either as an expense or as the medical expense or the medical premium. In the case of HUF, it is for any family member, medical premium, medical expense, preventive health checkup, which is 25,000 or 50,000 if it is for more than 60 years. Any questions other than this? Yes? Okay, let us solve one question. Mr. Ravi, aged 45 years, paid medical insurance of 22 to ensure his health as well as the spouse. He also paid medical insurance of 47,000 to ensure the health of his aged father, 65 years, who is not dependent on him. He contributed 4,600 to government health scheme. He has incurred 3,000 on preventive health checkup and his spouse, and 4,500 on preventive health checkup of his father. What will be the deduction? And remember, this is not available under 115 BAC. Yes.
Self, Mr. Ravi, on his self, he has paid 22,000. He is less than 60 years, senior citizen. He is not senior, so 22,000 will be available for him. And for his father, 47,000 will be available. It doesn't matter whether he father is dependent or independent. And for the preventive health checkup, 3,000 plus 4,500, total is 8,500, but maximum only up to 5,000 will be available for.
Correct. So he will get 25,000 for himself and 50,000 for his father. Right?
मैम 4,600 का क्या होगा मैम CGHS स्कीम का?
That is also covered under 25,000 only.
Okay मैम.
Right? Okay. Next is now 80DD. Deduction in respect of maintenance, including the medical treatment of a dependent disabled. Right? So, what does it say in case of a dependent disabled? So, it provides the deduction to a resident, being an individual or HUF, any amount incurred for any medical treatment, nursing, training, and rehab of dependent who is with disability, which is 75,000 normally, and in case of severe disability with 1,25,000. Right? So this is the income which is available, deduction which is available. Now, if the dependent who is there, let's say for example, the dependent gets the amount, right? When you are like depositing, this is for the either medical treatment. You can also deposit this particular amount for basically the pension for him, right? So here what they are saying is that if, for example, if there is a dependent who is there, now if he receives any amount from any pension scheme which is there, that is fine. It is exempt. However, if the person who was dependent with a disability, he dies, and the amount is received by the individual or the member of HUF, then that amount will be taxable in the hands of the individual. So basically what they say is that here a person will get the deduction for any medical treatment expenditure, also any payment to this life insurance company for the maintenance of that dependent, for the pension for that dependent. Generally we take, because they may not be able to function normally, we will create a pension account for them so that they keep getting the maintenance. Right? So, because if the person who is maintaining them dies, so in that case, they may get some money. Now, if that person gets it, if the disabled gets it, there is no problem, it's exempt. But if a person who was maintaining it and the dependent has died before him, then it will become taxable in the hands of that person. Again, 80DD is not available under 115 BAC. Clear? Next is 80DDB, deduction in respect of medical treatment. Again, this is available only to a resident, individual and HUF, which is available in respect of medical expenditure incurred on either himself or a dependent. So, what is the amount? Which is 40,000. Or if it is a senior citizen, it is 1 lakh. Now, these are for the medical treatment which are for the specified diseases. Again, this is not available under the default tax regime of 115 BAC. Fine. Next is 80E, deduction in respect of interest on the loan taken for higher education. So, if you wish to pursue any studies, right, you get deduction under 80E for higher education, either of self or for any relative. Relative here means the spouse and the children of the individual, or for the person whom is a legal guardian. What is the deduction? The deduction is the interest on the loan, and this is available for the 7 assessment years. This is available for the 7 assessment years. The deduction is allowed. So basically the initial assessment year and the future 7 years. So basically you can write here not exactly 7, but 7 plus the current year, which makes it to 8 assessment year. Okay, so this is allowed for the 8 assessment year. Again, this is not eligible under the default tax regime. Next is 80EE, interest on loan borrowed for the acquisition of the property. Now, usually for the acquisition of property, you get the deduction under which section?
24B.
24B. Now, this is over and above the 24B. This is over and above the 24B. What are the conditions for this? The condition is the value of the house should be less than equal to 50 lakh. Loan should be sanctioned during the previous year 16-17. Assessee should not own any residential house on the date of sanction of loan, and the loan sanction amount is less than 35 lakh. Basically for the low value housing. What is the quantum of deduction? Maximum 50,000, but this is over and above 24B. So 2 lakh you will get under 24B plus 50,000 you will get under 80EE section. Clear? Next is 80EEA. Again, these are not available under 115 BAC. 80EEA is in respect of a residential house property where the stamp duty value of the house is less than 45 lakh. Loan is sanctioned between 19 and 2022. You have not claimed deduction under 80EE, and you should not own more than one house when the loan has been sanctioned. What is the deduction? Here the deduction is 1.5 lakh. This is over and above, again, 24B. This is over and above 24B. Clear? So, if you look at it, if you go for the old regime, then you get SOP, interest restricted to 2 lakh. LOP, which is there is no restriction of the interest. However, you can set off against the other income only up to 2 lakh. Plus, you will get deduction under 80EEA up to 1.5 lakh. Under the concessional tax regime, SOP interest not allowed. Here, LOP interest or the LOP losses can be claimed against house property current year. However, cannot be set off against any other head of income. Plus, 80EEA is not allowed. Clear? Next is 80EEB. Interest on loan taken for the purchase of the electronic vehicle. Right? Interest on loan taken for the purchase of the electronic vehicle. Now, under the 80EEB, what are the conditions? Loan should be taken for the purchase of EV. Loan should be sanctioned between 19 to 23. Loan should be taken from a financial institution, NBFC bank, and it should be taken by individual. What is the deduction? Maximum 1.5 lakh. So this is only for the purchase of the electric vehicle. Clear? Any question, any doubt? Yes or no? Fine till now?
Yes.
Okay. Now coming towards the next section, which is 80G. Now 80G is for the donation to the fund or charitable institution. Now again, in the case of individual, this is available for the HUF, for AOP, BOI, artificial juridical person. This is available for all. However, this would not be available under 115 BAC. Only when you opt out of 115 BAC, you will get that. Right? So this is available for all AOP, BOI, company, anybody who contributes for the donation will get it. It is not restricted to only individual or HUF. Now there are certain deductions which are 100%. Like when you contribute as a donation, you will get 100% deduction without any qualifying limit. What are these funds? You don't have to remember all the funds, but these are basically either the National Defense Fund, Prime Minister Fund, the government related funds, right? Which are set up by basically government for the children, for communities, for Chief Minister's Fund. So all of these government, Prime Minister funds which are there, Clean Ganga Fund, these are eligible for 100% deduction. There is only one donation which is available for 50% deduction, which is the Prime Minister's Drought Relief Fund. That is subject to 50% deduction of the donation amount. Then there are certain donations which are available for 100% deduction but subject to a qualifying limit. Now, what is a qualifying limit? What is a qualifying limit? The qualifying limit which is there is, it is basically the amount of donation, the total donation that you have made under the category B and category D. Okay, this category B, 100% subject to qualifying limit and 50% subject to qualifying limit. Donations under B and D minus, if it is less than 10% of the adjusted GTL. So what they are trying to say over here is that the donations which are referred as the subject to qualifying limit, either 100% or 50%, should be first aggregated and they should be restricted to 10% of the adjusted gross total income. What is adjusted gross total income? What is adjusted gross total income? Yes, the adjusted gross total income is, you first have to compute your gross total income. You have to allow all other the chapter 6A deductions except 80G. Right? You have to consider first your gross total income, reduce the chapter 6A deductions other than ATG. In the gross total income, you don't have to consider short-term capital gain under 111A, long-term capital gain under 112, long-term capital gain under 112A, the income which are taxed at the special rate under 115A or all of these sections. Right? So, you don't have to consider the STCG or LTCG, the income taxed under the special rate, any exempt income, and you have to reduce all the chapter 6A deductions other than ATG. Are we clear? Fine. Any questions so far? Yes or no? Yes? Any doubt? Yes, students, any questions,
No.
any doubt?
No, ma'am.
No? Fine. So, this is how you will compute the adjusted total income. Calculate the 10% of adjusted total income. Consider what is the donation that you have made, which is subject to the qualifying limit, not the 100% one, not the 50% one without qualifying limit. Lower of that will be permissible deduction. Are we clear? So basically what they are saying is, see in the module also it is given step 1, compute the adjusted total income, that is GTL, reduce chapter 6A other than ATG. Don't consider STCG, LTCG, any income on which tax is not payable, income under 115A, AB, AC, ADD. 10% of your adjusted GTL. Calculate the donation, which is subject to qualifying limit. Lower of 10% of adjusted GTI and the donations made, which are subject to qualifying limit, which is basically this one, B and D. Right? So B and D, you have to consider in respect of the adjusted GTI. So lower of this is what will be allowed to me as the deduction. And first, since I have considered here both 100% and 50%, so I will first adjust the amount against the 100% and then balance what remains under this qualifying limit will be adjusted towards 50%. Clear? Any questions, any doubt? So what is under 100% subject to qualifying limit? Contribution to government, local authorities for family planning, some paid to Indian Olympic Association, and all the others are covered under 50% subject to the qualifying limit. Clear? Okay, any question?
मैम विदाउट क्वालिफाइंग लिमिट का अपन को पूरा मिल जाता है डिडक्शन, और सेपरेटली क्वालिफाइंग लिमिट के लिए सेपरेटली कैलकुलेट करना चाहिए.
Correct, yes.
ओके.
So 50% में आप see 100% में अपने गवर्नमेंट प्राइम मिनिस्टर रिलेटेड फंड्स जो है वो आते हैं. जो 50% में है विदाउट क्वालिफाइंग लिमिट ड्रॉट रिलीफ फंड आते हैं. So बाकी जो बच्चे गवर्नमेंट, लोकल अथॉरिटीज, इंडियन ओलंपिक एसोसिएशन, दैट कम्स अंडर 100% क्वालिफाइंग लिमिट विदाउट सब्जेक्ट टू द क्वालिफाइंग लिमिट. बाकी donation to funds, charitable institution in India are covered under 50%, whatever all other donation you give. ठीक है?
ओके. ओके मैम.
Any other question?
नो मैम.
Okay. Now donation to funds or charitable institution in India. Funds or trust should operate for the charitable purposes. It should not be wholly for religious purposes. The trust should be registered under ATG. they should furnish the statement of donations and certificate to the donor, and plus these trusts should be registered under 11, 12 or 23C, which we are going to see later. Okay? Any questions, any doubt?
No, ma'am.
Okay, so this is 80G section. Fine. Next is the donation can be made in cash only up to rupees 2000. Donation in cash is only up to rupees 2000, which is available. Clear? This you have to remember. Next is deduction in respect of rent paid under 80GG. Okay, deduction in respect of, okay, first we'll do 80GGA, then we go to 80GG. So deduction in respect of donation for scientific research or rural development. Let's go first to this particular section because it's related to the donation itself. 80GGA grants the deduction in respect of donation made for scientific research or rural development. So again, this is same to scientific research deduction which is there. Under 35. If you remember under 35, you get the scientific research deduction. So this is for the assessees who do not have income under the head PGBP. This is for the assessees who do not have the income under the PGBP, because if you have income under PGBP, you will claim under 35. This is for other than that. But it covers the same thing. Same as 35. Sum paid to Scientific Research Association, University College for Scientific Research, for Statistical Social Research, for Rural Development. So this is for assessee not having the income under the PGBP. They can also make donation up to 2000 in cash. And they can claim the deduction under this particular section 80GG. Third is deduction under 80GGB, contribution given by companies to political parties, and 80GGC, contribution by any person to political party. Eligible person is your company, here it is any person other than company. So for company 80GGB, others 80GGC. Right? Donation or advertisement in magazine, and here they say donation should not be in cash under both 80GGB or 80GGC. Clear? And if you remember, this is disallowed under section
40.
37.
37. Yeah, 37.
So you will disallow under 37 and you will claim under 80GGB for company, for other than company under 80GGC. All of this is not available 80G, 80GG, 80GGB, GGC, GG, or not available under 115 DAC. Next is deduction for the rent paid. So an assessee who is having the income under the head salary can claim the deduction of HRA in respect of the rent paid. An assessee who is not getting the HRA from the employer and is still paying the rent can claim the deduction under 80GG. What are the conditions? The assessee should not be receiving the HRA. Because if you receive the HRA, it is under 1013A. So no HRA received. Incur the rental for his own purpose. Right? He incurs the rental for the own purpose. He should not be receiving the HRA. And the accommodation should be occupied for his own residence. So the assessee, his spouse, his minor child, or the member of the HUF should not own any accommodation at a place where he ordinarily resides, so that he doesn't claim the deduction also, and he also owns another house. In HRA, there is no similar condition. Here there is a condition that in the place where you are living, I should not be having another accommodation, neither I nor my wife or husband nor my minor child. Major child can, because they can live separately, or the member of HUF. This provision is not there in HRA. There is a misconception that in the HRA, if you claim the deduction for rent, you should not have a house in same area. It's not like that. So if you have own house in same area plus you are staying on rent, allowed under HRA but not under ATWG. If any accommodation is owned by the assessee at any other place, not in the same place, it should not be a self-occupied property or a deemed let out property. It should be a rented out property. So it says if the assessee owns any accommodation at any other place, let's say he's working in Mumbai and he has an accommodation in Pune, that property should not be occupied by the assessee or should not be vacant. It can be let out. It can be vacant if it's so it cannot be vacant. Then only you will get under ATGG. What is the deduction amount under ATGG? Lower of rent paid minus 10% of total income, 25% of total income, 5,000 per month, whatever is lower. Clear? Again, this is not available under 115 BBA. Oh, sorry, 115 BAC. Clear? The last deduction, yes.
Here it is that the SSA should not, is not necessary that he should be an employee. It can be anybody.
Can be anybody. He can be employed but should not be receiving the HR. That is the condition.
Right.
Clear?
Yeah.
The last deduction, yes, please go ahead.
यहाँ पे ये बोल says that not receiving the HRA means he is being the employee, right? वो employee है लेकिन HRA नहीं receive कर रहा है.
Correct. He can be employee, he can be another person also, like business owner also.
Business owner भी claim कर सकते हैं क्या?
Correct. Yes, he can claim.
Okay, ma'am.
Next is the deduction in relation to ATU. Deduction in case of person with a disability. 75,000 in respect of normal, in respect of severe, 1,25,000. And in case you are claiming the deduction under 80D, right? Then you can't claim again under 80. You can either claim in one of the places, right? Plus, this is only applicable to a resident individual. Again, this is not applicable under 115 BAC. Fine. Any questions, any doubt? Okay.
No, ma'am. Clear, ma'am.
Fine. Now, I'm not starting with the income-based deductions for the reason that, that will take a little more time to understand, appreciate all those deductions because there are many issues in that. What we can certainly do is we can complete some of the small deductions from the income-based deduction. For example, we can deal with the ATTA in respect of interest on saving deposit. So we'll complete that. The rest of the income-based deduction, we'll do it in the next class. So deduction in respect of interest on deposit in saving bank account, ATTTA. So ATTTA again is available in respect of the interest. Now see, we have learned all these deductions which were investment based, expenditure based, right? Now, so if you are claiming the LIC expense, medical premium expense, if you are making investment in a house, if you are making investment in tax saving FD, you get these deductions. You get medical expenditure. Now we are looking at the income-based deduction, students, right? Which are linked to particularly the income category, right? So ATTTA, which is there, deduction under ATTTA, this is available for the individual or HUF. Can be resident, can be non-resident. If he has interest on the saving bank account, not the fixed deposit, what is the deduction which is allowed? Up to rupees 10,000. It can be saving bank account with a bank, with a cooperative bank, with a post office. Clear? So this deduction is available to the individual and HUF. If the income is derived in respect of saving account held by AOP or BOI, then the member will not be entitled, or a partner of the partnership firm will not be entitled to this deduction if the firm is maintaining this account. So this is only when an individual or HUF directly maintains this account. And this is available only when they exercise out of 115 BAC. So this is not available to partner or member of AOP or BOI if they maintain saving account. Clear? Next is 80TTB. It is available to a senior citizen who is resident individual more than 60 years. Greater than equal to 60 years if he maintains the saving account as well as fixed deposit account with bank. So this is covering interest on saving plus FD with a bank, cooperative bank or a post office. So this is, the bank can be normal bank, cooperative bank or the post office. Here also. Fine. Now, what is the quantum of deduction? 50,000 rupees. Here, the quantum of deduction for 80TTB is 50,000 rupees is what you will get. Again, it is not available if the partnership firm, AOP or BOI maintains these accounts, then these deductions will not be available to a partner or the member. And again, this is only available if you go for the normal tax regime. Are we clear? Fine? Yes or no? Any questions? Okay. Then one more deduction which I would like to cover is section 80M. I don't know if you have done that at the time of your IFOS. This is available to a domestic company. 80M deduction is available to a domestic company which receives the dividend from the other domestic company, a foreign company or from the business trust. Right? So they get a deduction under section 80M. So let me show you. 80M is basically the deduction for the intercorporate dividend. And this is allowed even under 115BAA or BAB. BAC is not applicable here because it is deduction available to a domestic company. So this is available under the normal tax regime as well as the concessional tax regime. If they receive the dividend from a foreign company, domestic company or business trust and they distribute the dividend on or before the due date. What is the due date here? 1 month prior to the return filing under 139(1). Then the deduction will be the amount of dividend received by it or the amount of dividend distributed by it, whatever is lower. So let's say if this company has given the dividend to holding company of 5 lakh, this holding company gives the dividend of 7 lakh, then this holding company will get a deduction of 5 lakh if it has received the dividend from the subsidiary on or before the due date under 139(1). And this is irrespective of the regime that you select. Clear? Fine?
Here, the dividend is paid by the holding company to subsidiary company.
Subsidiary will pay to holding, na? Subsidiary, the holding company holds the shares in subsidiary. So subsidiary
Yes.
will distribute the dividend to holding. Holding will
Yes.
distribute to its own shareholder. So holding can claim the deduction in respect of dividend received from subsidiary in order to avoid the cascading taxation. Clear?
Right. Right.
Ma'am, other
Yeah.
holding, if holding company has given the dividends of only 4 lakhs, then max deduction up to 4 lakhs will be allowed, right?
Correct. And this dividend can be received from foreign company, from domestic company, from a business trust also. But it
Okay.
should be received before the due date of return of income 1 month prior to that. So due date of return for a company is, let's say, 31st October. So you should receive by 30th September. If it's a company to whom transfer pricing is applicable, then due date is 30th November. You should get by 31st October. Fine?
Okay, ma'am.
Fine. So with this, we'll close the session today. In the next class, we will start with the other deductions based on the income. Please note we have a next class on 30th of September, not on Sunday for the direct taxes. So the schedule will get updated on the website, but we have a class on 30th September, not 28th. Thank you so much. We'll close the session over here.
Yeah. Thank you.
Thank you
Ma'am,
so much.
madam,
Yes.
handwritten notes upload करोगे क्या, ma'am? Because
I
today we
have already shared to the ICAI. They will be uploading it. Until clubbing, I have shared all the notes. I'll share for the carry forward, set off and carry forward, and for the deductions as well.
Thank you, ma'am.
Yeah. Thank you. Yes.